Welcome back to Small Caps, ladies and gentlemen. My name is Kerry Stevenson. Today, we're going to talk technical. We're going to talk markets. We're going to talk what you need to set up and take. Just be aware of, I guess. I'm talking to Chris Vermeulen. I don't know whether I got that last name right because I kind of butcher it every now and again, but he's the Chief Market Strategist and founder of technicaltraders.com. You can also find him on Twitter at the Tech Traders. And we're going to talk about what's going on in the markets. But before we get started, I want to ask Chris a little bit about his background. Here's a fun fact, ladies and gentlemen. He actually learned to fly a plane. This is crazy, Chris. Learned to fly a plane at the age of 14. Can't even learn to drive a car at that age. Chris, welcome to Small Caps. Great to see you.
Yeah, thanks for having me, Kerry. My pleasure.
That's wild that you could learn to fly a plane before you could drive a car. But let's get into a little bit about your background and how you got into technical analysis.
Sure. I mean, being a pilot definitely played a role later in life, but a couple of years later, when I was 16 in high school, we had our finance class, and there was a stock market challenge. Our school against other schools, everybody's given $100,000. The whole class had to agree on which stocks and to split the money on. And in a semester, we made like $80,000 plus, and I think everybody was blown away. I was too. I was like, oh my gosh, I don't have to go to work. I don't have to deal with people. I can literally just sit around and back then it was like open the newspaper and look through like the million symbols. I was like, this is amazing. If I can make $80,000 in a few months, this is what I want to do. So it got me hooked at that age. And then I started just kind of naturally reading and learning about it. I went off to college. I finally got old enough to open a brokerage account. My dad had to co-sign because I was still technically underage to have my own trading account.
How old were you at that stage?
I think I was 18 or 17, maybe, when I opened the trading account.
Okay.
Yep. So I needed a co-signer. He signed on, and I ended up buying Palm Pilot, which was my first stock. And we always had gone to Florida for the holidays, for Christmas and New Year's. And I didn't even think about it. I just bought it. I went away. I came back and I had like $8,000 in profits, and I cashed out. And back then, I mean, stock seminars were huge. Toronto, every weekend there was a stock seminar. You'd pay $1,000 or $3,000 to go. And I put all my money into buying courses. And back then it was, CDs and DVDs. So I just got really into it. And my goal was, I'm going to trade my own capital, and I'm just going to eventually share my own trades with everybody and run a subscription newsletter. So I was really focused right out of the hop. It's been my goal. And I've been doing that since my dorm room in 2001 is when I started that, which is pretty wild. So that's how I got into that. And I've done a lot of different trading and investing. You name it. I've done, stocks, covered calls, options, Forex, futures. I mean, I've done the whole gauntlet of all different time frames, day trading, scalping. And I just eventually kind of came to my own conclusion, like the style that I have now is what fits my style. I don't want to day trade. I don't want to be glued to a screen. I want to catch nice waves in the market and be able to put a lot of money to work. So I kind of veer a little bit from a lot of other people where I don't want to hold a bunch of stocks. I like ETFs, and I like it on big asset classes that you could move hundreds of thousands or millions of dollars in and just ride the tide in the stock market in these bigger waves. And that just fits my style of trading. And I found the stock market, like the stock indexes, have got the most consistent kind of wave-like patterns that reoccur on a monthly and yearly basis that you can just play. So that's where I've naturally gone, and losing money through the 2000 kind of bear market, the big tech bubble. I was even buying stocks that were doing really well in terms of earnings, but the stock price still got cut in half. And that was actually when I decided, fundamentals, I don't get it, because if you do everything right, you still lose money. So that's when I flipped the technicals, and I'm like, okay, well, forget the fundamentals. I can just literally eliminate all news, all data other than the charts. And I'm very visual. I like visual things much more. A chart's worth 1,000 words, so you can literally go through millions of pieces of data, a blink of an eye. So I got into the technicals, and I've never looked back. I believe in you just follow price. If price is going up, we want to be long. If it's not very clear, we stay out. If it's going down, we find a way to profit from falling prices or step aside. So that's where I've gone. And being a pilot has really helped in that regard, because even before I got into the stock market, it was all about learning the rules and regulations. of the airspace and what you can and can't do, which is a pretty thick book. And then you've got your checklist, strapped to your leg. And I mean, if you've ever gone flying, especially with an individual pilot, there's a checklist for everything. Checklist when you walk up to your plane, you got to walk around it. A pre-taxi checklist, a takeoff checklist. There's a checklist for everything, and that's what really came into play as soon as I got hooked in the stock market and I started trading real money. I just started writing down all the notes. I'm like, what do I have to wait for this? And what's the indicator for this? And so that's how I kind of got into the markets, was simply just stumbling and falling and losing a lot of money. Obviously, it takes years to really get a good grasp on the markets. And and realize you got to step aside sometimes and trade less. And that's what I do now. The less I trade, the better it is.
The less you trade, the better it is. You also said something a moment ago, which was, if it's not very clear, you stay out. Now, it appears to me at the moment, I'm sure other people, that the markets are not clear at all. And a lot of people are saying, whoa, we're back off to the races and the markets will be fine. But I believe that you're saying, just be a little bit cautious right now.
Yeah, I mean, I think we're coming into a pretty important turning point in the stock market where things could get really, really ugly. And I mean, I've only seen two of these in the past, which was the tech bubble, that burst. And then we saw the 2008. And I feel like this could be something like one of those. I mean, people call those a bear market, but really they are some type of major collapse. And I think we're coming into a major collapse because from a basic technical standpoint, 2022 was a bear market. Stock market pulled back 20%, but it has none of the characteristics of a real financial reset. That's just profit taking. That's just people moving out, getting nervous. I think we're seeing a lot of institutions cashing out and moving to the sidelines. When I watch the intraday charts sometimes, man, you can just see huge money just unloading into the buying volume. So there's definitely the big players, I think, are moving out. And I think we're going for a very big correction, which, I mean, I follow these 4 stages of the market, which we could get into here.
I'd love you to, yeah.
Yeah, let me show. Should be able to see the stages here. So I follow Stan Weinstein, his book. If you've never read it, it's a great read. Very simple read. He breaks the markets down into 4 stages. It's either going sideways, which is stage 1, a basing formation, which I color it red because it's kind of dead money. It doesn't have a clear trend in any direction other than sideways. And then we've got a stage 2, which is a bullish phase, and it's green because there's a big, strong trend. That's when we can make a lot of money. A stage 3 is a very difficult stage. We've been in this stage 3 pretty much since February or March of 2021 when it comes to stocks, individual stocks, especially growth stocks. And then it becomes very choppy. And that's what we've seen. We see waves of one sector doing well for a couple of weeks or a month, and then it falls out of favor again. And so this is a stage that you got to be very careful. It's tough to trade. And then we go into a stage 4, which is a full-on decline. And this is like the type of major crisis situation that I think could unfold. Really, where we are right now is in this stage 3. And if this is the case, we've got a long ways to go to the downside. And, there's a really easy way to view this, which would be Stan Weinstein uses the 150-day moving average, and so do I. More or less, if price is above the 150-day moving average, and it's moving up, you're typically in a strong bullish phase, a stage 2. When price starts to break through the 150-day and the 150-day is starting to flatline and it's chopping through there, you're probably in a consolidation phase, like a pause, or you're in a major topping phase, a stage 3. And then, of course, when price is below the moving average and is sloping down, you're most likely in a stage 4, a full-on kind of bear market phase. So that is kind of a high level how you view where we are. And we're definitely, from all the analysis that I have, we're definitely in a stage 3, and that's
sorry, Chris, to interrupt you. Just go back to that one, if you could, that we were just talking. Why is the decline, the stage 4 decline, in green? That looks to me like a green says go.
Well, because it's a big trend. Trends mean we can make money. It doesn't matter if something's going up or down. We can make money both ways. In fact, we can make a lot more money in a lot shorter period of time on the downside. Because I always tell this to subscribers. I say the stock market, goes goes down about 4 to 7 times faster than it goes up. So you can wipe out 3 or 4, 5, 6, 7 bars of gains in one red bar to the downside. And bear markets collapse. It could take 7 years to rally and be wiped out in 1 year. And so those downside moves, I mean, it's huge opportunity. Trading a bear market is very different than a bull market. It's very quick, you got to be a little more aggressive to get in, aggressive to get out. But it's green because it's a big trend. It doesn't matter which way it goes. We can make money with inverse ETFs. You can short stuff. So there's a lot of ways to benefit from that going down.
Okay. Thanks for that. I was just, yeah. Okay.
Yeah. So where I think we are is kind of in this complacency stage. I mean, we're going to see some pretty big movements here with the Fed. It's going to be interesting to see where we go. But overall, we're in this complacency phase. I think a lot of people are thinking last year, 2020 was a bad year and that the bear market's over. And a lot of people, a lot of headline news that I'm seeing, depending on the feed you're on, are getting very bullish. People are buying, they're piling in. And I think we could see this complacency stage potentially last maybe even a couple of months. We continue to grind our way higher. But if it rolls over and starts to break down, we're going to see a very big decline. And it'll be the start of, people starting to panic. They're going to get anxiety. They're going to be in complete denial once it falls a certain level that they cannot believe it's happening again and how far they are. And it just gets worse from there. I mean, the scary part of what's going on right now is we're on the cusp of a major, I think, financial crisis again. Whatever is going to spark it. It could be World War III, could be who knows. But these crisis phases are really powerful. So there was a study done. They found that there was over 6,500 suicides in 2008 to 2009. Small window, and they were directly related to the financial crisis, the drop in equity prices. And so people don't understand. The problem here, I call it like the perfect storm, because there's the majority of people are baby boomers. Everybody's got, as much wealth as they've ever had, and they're going to potentially lose half of it going forward in the next year or so. And it's the worst possible time for them. They're not working anymore. They're kind of, out of that phase, and they could lose and completely have to downgrade their lifestyle, which is why this is so important. So many people want to be making money. They want to trade. They want to make more money. The reality is right now you should be preserving capital. If you make a little, be happy, but you got to be protected for this potential breakdown to the downside. I'm not saying it's going to happen for sure. It might not happen. For all we know, we rip off into some new bull market with some new stimulus or something.
Yeah.
But that's the nice thing about technicals is we just follow price. If it turns back up and all of our signals give a buy, we can just get long and ride it back up. But you just do not want to be stuck turning a blind eye to this market, because if it does collapse, it's going to be lights out. You're gonna have to downgrade your lifestyle. Everything changes. And the scary part is when we go and look at the cycles of the market. So there's the blue cycles here. The blue cycle is the stock market, and then the yellow cycle is the economic cycle. And so the stock market typically always tops first because investors can see business slowing, sales are slowing, forecasts are slowing for businesses. So investors start to trim back because they see things getting worse. So the stock market always tops out first, and then the economy rolls over months later. The recession is, proven with the numbers. The economy is very slow. The problem here is energy stocks last year were one of the best sectors. This year, precious metals and miners are kind of leading the way. They've been doing exceptionally well, and they typically are the last couple of stocks or sectors to do really well just before the market kind of goes for that, that swan dive. So that's the really scary part here is everything on these charts are kind of lining up to we're in this perfect scenario for a pretty big pullback. And when you look at small cap stocks in general, the small cap sector, they've got a pretty ugly chart. Actually, if we go take a look at let's take a look at the Russell 2000 real quick. If we were to zoom back here and go back to 2007, 2008, obviously this chart goes up and to the right pretty far, but if I just draw where we potentially are right here. So we had the 2008 top here, 2007. And then the market broke down below this low, and then it formed this complacency rally. People thinking, oh, it's we're finally, we've had the bear market, it's coming. And then the bear market's over, and then it goes for that stage 4 decline, the big collapse. Well, we've kind of had the same. We've had the topping phase. We had small caps top. They've broken down, and now they're kind of just forming this pause, a bear flag pattern that points to dramatically lower prices going forward. And I think we're in a very
sorry to interrupt you, Chris, but then like if you'd stuck with it and stayed in the market, it had quite a strong rally afterwards. Is it smart to be popping in and out of the market, because doesn't that in itself cause issues?
It can. I mean, the buy and hold strategy, I think, is great for people who are younger, right? I think if you're kind of 45 plus, the older you are, the more dangerous it is to hold, because here's the problem. We go back to I'm gonna pull up the SP 500 here, just because it goes back further than the Russell. But we're getting back into a scenario where we're getting into a multi-year drawdown, a 3-year bear market. The scenario we have with the US dollar pricing, US dollar is right now is priced the same as it was back in 2000. Commodities are like the most undervalued asset, just like they were back in 2000. A lot of things are coming together, meaning I think we could see a multi-year, very weak economy, very weak financial system. And the problem here is if that happens again and we just draw a line across these tops, I mean, you really didn't start making money in the SP 500 for like 12 years. And if you are 50 years old and you're withdrawing at a 40 to 50% drawdown to live off of, I mean, you're just killing your future of the lifestyle that we all kind of want and picture, right? And we envision. So that's the problem. If you're younger, I mean, you can just go ahead and buy and hold more or less because you've got time. But for somebody who's in their like second half of their life here, you don't have time to wait 3 years, 5 years, 12 years. I mean, the NASDAQ took 17 years to come back. I mean, I just believe that if you've got a lot of wealth and, you're in the later stages, you might as well protect it. And the problem is a lot of people don't know how to do kind of what I do. It is more difficult to get in and out if you're not living and breathing the markets. And that's where I specialize in, is identifying trends and being able to move in, catch the wave. If it starts to roll over, we move out if it looks really bearish. So there's a lot to it for sure.
But Chris, I'm talking to you from Australia. You're sitting up there in Canada. Would your type of strategy apply to people in Australia, or are you looking global, or are you looking, how does that work?
Yeah, so the strategy I use, like if we were to take a look here. So this is like the NASDAQ. So, I mean, we've got a lot of subscribers in Australia. They're one of our largest groups other than from United States and Canada. So it's a very big part. As long as you can trade an ETF, some type of asset that follows the SP 500 or the NASDAQ, because that's what I focus on. I like to, these are my kind of analysis. When it's red, you do not want to be in the market, or you want to be short or buy an inverse ETF. When it's green, you can get in, and we've got profit targets and things like that. So this is like the type of strategy that I focus on. And if we were to look at it from a long point of view, like this was the COVID crash. I've got multiple layers of time frames, and this is what allows somebody to be able to identify major trends and move in and out of the market. Is when we were in a bull market, which after COVID, we saw a breakout here, and the market gave us this technical sign saying, hey, we're in a bull market. The tide is going up. That's when you want to be in stocks. They're you can go very aggressive. You get strong breakouts in the first half of a bull market leg, and that's what you want to be. And for example, if we were to stretch this chart up, this chart down here is the ARK ETF. Everybody knows the ARK K ETF. More or less, in the early stages of a bull market, you can have these massive runs, hundreds of percentage points in stocks or even sectors, and do very well. But what happens is eventually the stock market starts to break down, like the stocks start to break down, and the stock market will keep going, but people who are just trading in stocks suffer a lot. And this is the problem. This is why I like to focus on the indexes, because you can play the full trend, and then when it reverses, you're to the downside. And if you notice, from COVID to the top, it's pretty much all green, very strong trends. And then once there was a sell signal and we're in a bearish phase, the majority of the time is red. And when we look at, trading the NASDAQ, you've got very strong trends to the upside. And then during a bearish phase, you've got most of the time the bars are red. And so anyone can trade these. I have people following the signals in over 130 countries. And pretty much every company, every country has got some type of fund or mutual fund ETF that allows you to trade the NASDAQ or trade the SP 500 or treasury bonds. So yeah, anyone can use these. The key is just being able to identify when you need to be in, when you need to be out. And that's what I kind of specialize in, is that type of trading.
Well, Chris, let's go back to that. If people were interested in what you're doing, can they do it the lazy way? In other words, can they just turn around and go, Chris, I'm not really fully understanding the markets and what's going on. Here's a chunk of change. Can you do you do that, or do you say, listen, I'll give you the tools for you to manage your positions?
Right. So we do both in a way. So I provide the newsletter. So if somebody has their own brokerage account, they get the trade signals, they can trade those. They're end of day signals, which is easy. So we wait for a closing bell, and then we send out the alert at night. So you have all night and all morning to place your order, and you just enter at the open the next day. So it's a very straightforward strategy to use. So a lot of people do that, but we have a lot of people who don't want to do it. They don't know about the markets. They don't have the time for it. So we offer auto trading. We don't manage their money, but they can open a brokerage account, and then they would, we would tie our system into their brokerage platform. And so whatever trade that happens with the strategy goes off and automatically trades in their account. So they can kind of just set it and forget it. And just follow suit that way.
Okay. One of the comments you've made recently was brace for a fully fledged bear market, and a suggestion that people should potentially pop themselves into cash. Like, cash is your friend right now. A lot of people say cash is trash. Cash is your friend. Can you make money sitting in cash in a high inflationary environment? Where there's a disconnect between what interest rate you can get and inflation?
Yeah, well, if you compare it to inflation, no, you're never going to beat inflation. But instead of just having your money do nothing, you can still move to a brokerage account and earn your 4%, or you could go to like an ETF like BIL, which is a 1 to 3 month treasury note ETF, and you can just move to it like a cash position, and it just pays you dividends. And you just collect interest, but it's almost the same as what you'd get if you just left your cash in a brokerage and they pay you. So you're not beating inflation, but you are still making money. Eventually inflation will come down. Like, there's no way, anyone can just go and beat inflation very easily. I mean, when it's at 13, 15%, whatever it really is, it's pretty tough to beat. The key is to just keep making as much as you can. And when there isn't a good asset like, stocks or bonds to be in, you can move to cash. And another way we play it is the US dollar ETF. The US dollar was one of the best assets last year. It was something we traded. So instead of being in stocks and bonds, both were just falling out of bed. We just moved into UUP, and the thing just kept going up and up. And so the key is you need to rotate to the asset that's rising. And that's my focus. If it's not going up, we're not in it. If there's something that is going up, we want to move to it. And if nothing meets our criteria, which is fairly strict, then we're actually just sitting in cash, collecting interest, and waiting for the next trade. Because, one of the big things is so many people get into dividend stocks, and they're like, well, I'm in the big blue chips, I'm getting my dividends, I feel really good. Well, the problem is when we go into a bear market, dividend stocks, sure, they outperform the stock market. But if the stock market falls 34% and your dividend stocks fall 20%, yeah, you outperformed the market, but you didn't make any money. You still lost 20%. You just didn't lose as much. And so people would rather hold a blue chip stock for like a 3 or 5% interest when it falls 5% in one day and is wiped out. I don't get it, because I don't believe in holding stuff that's falling. So I'm like, why would you hold on to something for a 2 or 3% interest or 5% when it's going to fall potentially 20 or 30 or more? just buy it later and sit on the side and go do something else with your life while the markets are falling apart. That's the way
Chris,
I see it.
I think I needed to hear that right now for so many reasons. Can we just talk about precious metals? Because when we were looking at that chart, you said energy and precious metals were the last ones to roll over. A lot of people saying that, including myself, that 2023 is going to be the year for precious metals. It's been a tough number of years, and also in troubled markets, a lot of flight to safety. We know that the cryptocurrencies have had a hard time. There's money moving from that sector into precious metals. I'd love to hear your view on what you think's happening there.
Sure. You know what? Let me share my chart real quick here and give you the look of gold. So my take on gold, and obviously anyone who loves gold and is super bullish isn't going to like this view. The long-term view looks really good. I mean, we're in what I think is a super cycle to the upside. And I talked about this, I think it was back in 2021, maybe it was even 2020. I talked about how we were going to see gold rally up and then eventually have a cycle low more or less last year. I got a feeling it might be delayed a little bit. But long story short, the scenario where I think we're at is very similar to the major low in gold back over in 2000. I think this was the time when the dollar was super high valued. This is when commodities were the most undervalued asset for the time frame. I mean, they were just, everybody was piling into stocks and real estate. Same as what's happening right now. Yeah. I think the super cycle started in like 2019 for gold and precious metals. But what I think is going to happen is I think we're going to eventually see potentially big selling hit the market. Unfortunately, when there's a financial crisis and a huge flush down, we could see, I think, gold, silver miners pull back quite a bit.
Wow.
Even within this super cycle from 2000, we still saw a 34% pullback in gold. And I don't think that's out of the question. I think we could see a 34% pullback potentially in gold. Not because, I mean, it is the perfect storm for gold to go higher from all the stuff that's going on with interest rates and the economy, all that stuff. But it doesn't matter. There's not much liquidity. This market is so fragile that when the selling hits the market, everything just gets sucked down. Yeah. And then when this big bear market kind of cleanses in precious metals in the stock market, it'll put in a major bottom. And that to me is when like a 5 or 6 year multi-year rally in gold in miners take off. And I've talked about this many times. I would love to see gold flush down with the rest of the market, cleanse itself. It'll give a great opportunity to get in for what I think will be the last major pullback in gold and metals before they're off to the moon, right? So these are big 10-year cycles. These take a long time to unfold. I think we're still a year or so out. If we're lucky, we might see gold bottom. Maybe it's already bottom for all I know, but we could see gold bottom later this year with the stock market. Wherever that is going to be. And after that, I mean, gold will be one of the first commodities to run. So will gold miners. They typically rally before the overall stock market does. So there'll be a good early warning. They're going to be one of the strongest sectors. And we're probably going to see, $3,000, $5,000 gold at some point. I think it's just going to do one of these giant, off to the moon type of rallies. And this one could be bigger than others. I think we're in a much better scenario now than we were when gold made this run before. So we could see some pretty exciting prices, but there might be a lot of pain in the next 12 to 18 months before that. And if we take a look at the dollar index, just so I can give you a kind of a visual of the dollar index, here's the 2000 market top. And this is kind of, obviously we've had a strong pullback in the dollar, but I feel as though the stock market's going to eventually have this big collapse and we're going to see the dollar come back up. Maybe it's going to push even higher. Eventually it's going to put in a major top. And then we're going to go into a multi-year sell-off in the dollar, just like we saw after the 2000, the sell-off started. So I think the dollar could have a lot of strength, and that's going to put a lot of pressure on metals, along with the liquidation of everybody selling their assets and margin calls. So that's the scenario that I think is unfolding. Now, with the market having a strong rally, the precious metals market in the last couple of months, Gold's looking really strong. Of course, it's got everybody thinking it's started the new rally. It's going higher. I still think it's a false rally at this point. I think it's going to roll over. It's going to sell off in a pretty big way. Dollar is going to go up. There's going to be this reset first, and then everybody can be excited about it, because I think it'll be up and to the right.
But you don't. But you think that's going to take sort of 12 to 18 months to play out. So 2023 is going to be not only choppy, but quite frankly, a little bit dangerous for investors.
I think it will. It's tough to tell, because this stock market could fall so fast. The Fed can do all kinds of crazy stuff. So for all we know, the market could have some crazy crash that happens in an accelerated period of time. The Fed, he's been loading the gun. They've got so many bullets. How many quarter basis points do they have in that thing now? I mean, they had almost none before. Now they got like enough for a machine gun. So as the market rolls over and starts to sell off, they can start dishing out the rate cuts to try to save this market. But I think things are going to be pretty ugly potentially this year. And I think this whole year is going to be just a real wild ride. Mostly, I think, negative. But again, we just have to follow the trends and see which way they're going to go and ride that trend.
Okay, Chris, we're running out of time. There's a couple of things I wanted to ask you. I guess, first of all, ladies and gentlemen, please make sure you do your own research and don't put a dime of your money into this market until you've had advice, either from your financial broker, whatever. But Chris and I are just having a chat about what we think is going to happen. The other option is make sure that you go to technicaltraders.com and sign up, because they've got some free tools in there as well, which can help you. If you don't want to subscribe straight away, you can actually have a listen to Chris and what his strategy is and some of his proprietary tools. Now, Chris, let's wrap it up, if you like, in a Tiffany box, and give us 3 pieces of advice that you would give to our audience out there. They are investors. They're looking at the market. Some of them are aggressive, but some of them are confused. What would you say to them?
Well, if you're an investor, I would put some type of protective stops in place for some positions. I mean, this market, if it rolls over, I don't think you really want to hold for a big washout. I think there could be a great opportunity to get into individual stocks down the road. I mean, who would have thought, Tesla would be down where it is, right? Anything, even the best stocks can crash. So I would say, just find a way to protect your capital or lighten your load, because the risk here is higher than ever. If there's ever a time somebody needs to decide to be a little conservative and not just own a whole bunch of stocks and growth stocks and things like that, this is the time. Because if this scenario happens, we could be underwater for 3, 5, 10, 12 years before we start going to all-time highs, which nobody wants to believe, nobody wants to think about. And you're way better to avoid that and keep your current lifestyle, keep your current wealth, your lifestyle, while everything falls apart. If the market starts to take off and rally, you can always get back in and ride it up. It doesn't matter if you miss 5, 10, 15%. If the market's starting a new bull market, it's going up, 100% or more over the next several years. So there's lots of upside potential. Just, you don't want to, this is the opportunity, I think, to protect yourself. That's about it. I mean, you really just need to decide if you have enough time to buy and hold, or if you need to be a little more aggressive and protect your current situation, which to me is the most important. Nobody wants to go backwards. It's not a pleasing experience.
Well, Chris, it's been absolutely delightful I think it's been delightful. I think it's been a bit crazy and scary, but as I said before, people can follow you on Twitter. They can go to your website. Chris, why don't you and I have a chat towards the middle of the year and see how things are going and see whether we're still wobbling across, or maybe some of the things you're talking about are playing out.
Yeah, sounds great. Appreciate it.
Okay. But for now, thanks for joining me on Small Caps. We'll see you again soon. Thanks, Chris.
Thank you.